So, good morning, all. We are good to go. Welcome to today's webinar on all you need to know about bonds. So, if you have ever wondered how bonds work, why they are important, or how they fit into your investment portfolio, you are at the right place. Because whenever you're new to the bonds or looking to deepen your understanding, this is the right time. It's like where we are gonna demystify and know more about the bonds, wherein starting with the basic features, how to invest in bonds, what are different types of risk involved, and what are different types of bonds. So this session will provide you the insights you need to confidently navigate through the bond market and make some informed decisions. So we'll explore more. So the question we'll start with is this in the time of all-time volatility, when can investor turn for safety? Here you see four different type of investors who really need to allocate to fixed income today. So, and if you relate to any of the statement, let's say, for example, last few years, you have made good returns in small cap. Let's say, for example, if you have short-term goals down the line, and if you consider yourself as a conservative investor and so, or let's say, for example, if you just started out in the market and if you are just started 3 years back and so, and if you would like to explore the probability in your portfolio asset allocation and so, this is a great time to evaluate a fixed income product and add it to your portfolio asset allocation. So in this webinar, we are going to deep dive about starting with the features. So bonds offer several key features that make them attractive choice for many investors. So let's break down the most important ones. What's suitability? So bonds can be tailored to fit various investment goals and risk tolerances and so. So making them suitable for conservative to balanced to an aggressive investor, considering a portfolio asset allocation point of view. Apart from that, portfolio stability. By including bonds, you add a layer of stability to your portfolio, especially in volatile markets like this. This can reduce your overall risk of your portfolio on a weighted average basis. Apart from that, let's say, for example, if you're already retired and if you want regular income to be provided from your existing asset allocation, bonds provide a predictable income stream through regular coupon payments, making them ideal for your steady cash flow requirement during your retirement and other goals too. Apart from that, for contingency planning, so we as financial planners, we always say at least 6 months or 1 year of expenses, you need to keep as a contingency or emergency reserve. For this, it's like there are liquid funds, overnight funds, short-term funds that are very suitable for this specific contingency reserve, building up the reserve, because this provides you the capital preservation and safety that you need rather than compounding that's going to get in the other asset classes and in the bonds too. So contingency planning, apart from that, liquidity management is also one important thing. So this investment is one tool for managing liquidity. This ensures you have access to funds whenever you need to without having to sell your other investments. Apart from that, let's say, for example, to fund your goals. So if it is a large purchase that is 1-2 years down the line, if you have an education loan, education goal that is 1 year, 2 years down the line, and let's say, for example, even if it is retirement that's 7-8 years down the line, there are different types of bonds and fixed income instruments that can help you in this entire financial journey. So to moving ahead, we'll start with a very basic thing. What is actually a bond? So one thing is, bond is essentially a loan that you give to a government or a corporation. In return, they promise to pay you a regular interest and return the principal whenever the bond matures. So let's say, for example, if company ABC wants to raise a capital, they have two options. One is they can go to IPO and raise by a share route. Second is they'll issue bonds. And actually, it's like, let's say, for example, you would be the lender. You would be lending certain sort of amount based on the requirement, and the borrower would be promising certain set of coupon payments for you, and they will also lock in whatever the maturity date is for you. So that's the way generally the bond works. It's like there will be a borrower, a lender. You would be lending your money on so and so capital, and you will get certain set of coupon rates based on the agreement or deed that you're going to be passed on to. So coming to the issuers. So in India, bonds are issued by various entities. So each catering to different needs and offering unique risk and return profiles. So we'll explore more about this and why do they raise bonds specifically. So let's say, for example, start with central government, the government of India that raises government securities, that is GSECs. So this government securities are raised to fund national projects such as infrastructure and to even manage countries' debt at certain times. And comparing to other classes and debt, these are considered as the safest bonds due to the sovereign guarantee that they provide. Apart from that, let's go for example of state government. So for Tamil Nadu itself, they have Tamil Nadu State Development Loan, that is SDLs, that are provided by the state to raise funds to fund their state-specific infrastructure projects, healthcare, education, and various public services thing. So one thing is, while slightly these are riskier than the central bonds, they offer higher yields generally. Apart from that, we're moving on to public sector entities. So let's say, for example, NTPC bonds. So government-owned companies like NTPCs, PSUs issues bond to finance large infrastructure and power growth projects. So these bonds offer a balance between safety and return and leveraging government backing. So that's one thing. So apart from that, there are banks that they provide bonds and fixed income instruments like bank FDs, corporate FDs, and so on. So in that, what banks do is bank like SBI issues bonds to meet their regulatory capital requirements, especially under the Basel norms. So these bonds help strengthen the capital base while offering investors stable returns. So NBFCs. So let's say, for example, HDFC Limited bond or something like that. NBFC issues bonds to raise capital for their lending activities, housing finance, and consumer credit. They typically offer higher yield to compensate for the greater risk they accumulate for. Apart from that, you would have already heard about corporates and venture debt. So in venture debt, specifically what happens is they actually issue bonds to raise capital to fund high growth startups. These bonds offer actually a potential of high returns, but come with higher level of risk. So as you see, it's like all this issued bonds have different types of risk category and so on. And we'll be discussing about the more risk factors in later in a PPT. So let's say, for example, you are going to start investing in bonds. So what you should actually look for. So while evaluating bonds, there are several key factors one should consider to ensure you're making a very right choice. So one thing is underlying business. You need to understand the financial health and the business model of the issuer. Especially with the corporate bond, a strong underlying business means a higher likelihood of regular corporate coupon payments and safety on the principal repayment and so on. So there's something called as covenants. So these are the legal agreements and protect the bondholders. They include limit on how much debt the issuer can take on the requirements for maintaining certain financial ratios and helping to reduce default risk and so on. So there are two types of this, that is positive covenants and negative covenants and so on. Apart from that, coupon payments. So you need to see it's like how the bond pays interest, whether it fits your income needs. Let's say, for example, it might be fixed or floating, monthly, quarterly, half yearly, and so on. So coupon payments is something you need to be looking for. Apart from that, maturity. Bonds have short, medium, or long-term maturities. Short-term bonds are less sensitive to interest rate or credit risk changes, but whereas long-term bonds typically offer higher returns, but come with certain risks that includes like referring to the interest rate risk that happens in the market. We need to also look for credit rating. So credit rating agencies like CRISIL or ICRA assets, these assess the issuer's ability to meet its obligations. So let's say, for example, a higher rating of AAA suggests lower default risk, whereas in lower rated bonds such as BB or lower, often higher returns, but it comes with very higher risk. So apart from that, one thing we need to be sure about is convertibility and default risk. Some bonds often option to convert into shares of the issuing company, which can be an attractive feature for the company's stock to expect it to rise. As long as this aligns with your goals and do a thorough research in this specific thing. Apart from the default risk, always consider the likelihood of default. High yield or junk bonds often tempting returns, but carry a significant risk to the issuers being unable to make payments. So that's something that you need to be sure of. Apart from that, okay, so what you need to look for while analyzing a bond. So this is some example that we have taken. This is not actually a sell recommendation or something like that. So you can see on the screen essentials, the coupon rate, 9.85%. On this basis below itself, they have mentioned as interest payment would be frequency would be on a monthly basis. So let's say, for example, if you're purchasing a bond value of, let's say, 5 lakhs or 10 lakhs, there would be 9.85% interest divided by 12. That is going to be paid out monthly basis. And the maturity is after 1 year, 11 months. So let's say, for example, if you have a goal 2 years down the line, 2.5 years down the line, based on the credit risk rating and evaluating the specific bond, you will be able to make an informed decision and make use of this thing. Apart from that, how do you make returns in bond is what generally like investors or clients ask us. It's like understanding one thing is understanding how bonds generate return is one thing is we need to see if it aligns with your investment goals. Suppose, for example, coupon payments. So bonds pay regular interest called coupons. So as I said, about 9.85% in the last example, usually it's on a monthly or semi-annual or an annual basis. This provides a predictable income stream. Let's say, for example, if you're in your retirement phase and you need a monthly income plan or something like that, at that time, it's like there are a lot of government securities, corporate bonds, and so on, which you can make an informed decision and streamline your monthly requirement. The coupon rate is generally fixed or variable depending upon the bond that the issuer is issuing. Apart from that, if you're looking for steady cash flow, bonds with higher coupon rate might be appealing. But as I said, it might come with a higher risk. So one thing is what is making return during the maturity. So at maturity, the bond's principal, known as the face or par value, is repaid to the issuer. So return of an initial investment is guaranteed in the specific bond. So let's say unless the issuer defaults, actually, for those seeking capital preservation, holding a bond to maturity ensures you get back the full principal along with the coupon payments received over a period of time. So what about mark-to-market gains? So bonds can be treated with a bonds can actually be traded in the secondary market before they mature. So if the interest rates fall or the issuer's credit rating improves, the bond's market price might actually increase, right? So this allows you to sell the bond at a higher price than you bought it for. So generating capital gains. However, if rates rise, the price of the bond may drop actually. So leading to potential losses if you're selling it early. So these are the cases. It's like where you can make actually returns by investing in bonds. So we'll talk more about it's like what are the coupon structures that are generally available. So one thing is bond actually come with different coupon structures which impact how and when you receive the interest payments. We'll explore each starting with fixed income or fixed coupon actually. So in this structure, the bond pays a set interest rate throughout the term. So the rate remains constant, providing stable and predictable income, making it ideal for those seeking reliability or like safety. Apart from that, zero coupon bonds. Those bonds don't pay regular interest. Instead, they are issued at a discount to their face value and pay the full amount at maturity. So the interest in the difference between the purchase price and the face value. So apart from that, these are great for investors looking just to lock in the lump sum and return at the maturity rather than just any periodic payments and so on. Let's say, for example, in zero coupon rate bonds, what happens is, let's say if you are purchasing a bond of 900 rupees, and if the holding period is 2 years, in between you won't be paid any coupon rates and so on. And at the maturity, you would be paid based on the market value. It's 1,000 or 1,100 rupees. So that is going to be the gain that you will be getting. Apart from that, what is floating rate bonds? So the interest rate on these bonds varies over time to time, usually tied to a benchmark like a RBI's repo rate or a treasury bills rate, this coupon adjusts periodically, which helps protect against rising interest rate. But also it actually means it would be fluctuate. It would actually arise fluctuation in your income. So that's one thing about the floating rate bonds. So moving on to, okay, how does the bond market work? So from here onwards, my colleague Samyukta would be taking forward. It's like I'll pass it on to you, Samyukta.
Hi, Vinayak. Thank you for walking everyone through the first half of our presentation. So I thought I would look at a few elements of how the bond market works, because this is one space where a lot of investors don't really understand the mechanics of the bond market, but there is some merit in paying attention to how it works so that you can set the right expectations when you're making an investment in bonds. So the first thing is that we need to understand that this is an over-the-counter market, which essentially means that if you want to participate, the easiest way to do that is through a broker-dealer and not necessarily directly through the exchange. So if anyone here is an equity investor and you participate in the stock market, you can mostly invest in stocks through an app or through your broker, right? So when you do it through a broker, basically in this market, what tends to happen is you have larger institutions which hold bonds on their books, and based on requirement from both other institutional investors as well as retail investors, they may buy or sell and engage in trades. So there are two types of bonds in the market. And this matters when you're looking at how your investments will be taxed. One is listed. So listed bonds are taxed in a very similar manner to listed equities, and unlisted bonds are taxed in a manner that's similar to unlisted equities. Of course, we know that with debt, like your capital gains, if you're looking at other instruments like mutual funds, etc., are going to be taxed at your slab rate. Now, because this is a market where you mostly have large institutional players and that it's an over-the-counter market, the liquidity here is very less. So for a retail investor, the best way to look at a bond investment is not really to look at buying and selling very quickly or to look at it as a trading instrument. This is more of a buy and hold instrument because there is a cost to enter into each transaction. And in terms of exiting also, it may not happen as smoothly. You might need to be a little bit more patient with your exits. So this is largely how the bond market works. So as an investor, you basically need to pay attention to how liquid your investment is going to be. And that's also a function of who is issuing the instrument, right? So like Vinayak rightly pointed out, you have different institutions, whether it's a government, whether it's a corporate, whether it's a bank or a non-banking financial company, or any instrument issued by these players will have varying levels of liquidity. So you need to pay attention to liquidity. You need to pay attention to impact cost. That is, what is the cost that is going to what is the cost that you are going to incur to enter into a trade? We can move to the next slide. So one important thing as an investor that each person needs to understand is what is the difference between a coupon and the yield. So there is some text on the slide, but I would suggest that we can just have this as a conversation. So like Vinayak talked about, the coupon is basically the interest payment that the issuer agrees at the beginning of the contract, right? So when they issue the bond, they'll say that maybe it's a 9% coupon, and the coupon frequency is also decided in the bond, right? So a coupon is a fixed payment that you receive through the life of the bond, and that is not going to change. The only scenario in which it changes is if the bond itself is a floating rate bond, in which case, depending on how the benchmark moves, your coupon structure will also change. And the second instance is something that you really don't want to happen, which is if there's a default, then you may not get the interest or there might be a delay in the coupon payment. Now, the coupon is always calculated on the face value of the bond. So if your face value of a bond is 10 lakhs and you have a 9% coupon, then you're going to basically earn that coupon on 10 lakhs, right? If you have a coupon of 9% on a 100 rupee face value, then the coupon that you'll earn is basically 9 rupees. So it's always paid on the face value, and it's not paid on what price you buy the bond at. Now we'll talk about yield, because yield is basically what investors actually pay attention to when they're making an investment, right? The coupon is just something that you earn through the life, but the yield is basically the net return to you. And there are certain assumptions that you need to understand when you're looking at yield as a metric. So firstly, the yield basically is calculated on the price of the bond and not on the face value. And because bonds are traded instruments, the price can change on a day-to-day basis. So your yield will also change on a day-to-day basis. The second is that when you're calculating the yield, you assume that whatever coupon or cash flows that come from the bond are actually reinvested at the same rate, right? And this may not be a realistic expectation, because let's say you started an FD in 2020, then probably the FD rate was at 4 or 5%. And if you earned that 4% interest and you were investing it today, you would be able to invest it in an instrument that's giving you 7% return, right? So your reinvestment need not always be at the same rate at which you're getting the interest. So that is basically one assumption. The second is, of course, that you assume that there's no default when you're investing in a bond. So the yield essentially is your total return in terms of calculating the present value of all the cash flows that you're going to get through the life of the bond. And that is a metric that investors use to measure the return. Now, it is a much better metric than the coupon rate, but it is not a perfect metric, as we have just discussed. So let's talk about a few risks that exist within the space of fixed income, because a lot of investors sometimes assume that there are no risks as such, right? But there is no such thing as a risk-free investment. You have risks arising from default, because essentially what happens is this is a contract that's built on trust as well as the financial strength of the underlying entity. So if the underlying entity goes through bankruptcy or has issues in generating cash flows, then there is a possibility of a default occurring. And we've seen defaults in the past. The second, of course, is in terms of liquidity. So when we talked about the structure of the bond market, it's not a very liquid market. SEBI as well as the RBI have been trying to increase liquidity for retail investors. And I think that is showing up in the level of participation and awareness that is there today, because a lot of people do want to participate in fixed income and in bonds, right, specifically. So some of the measures that have been taken to improve liquidity in the market include the RBI retail direct platform, where they wanted retail investors to directly be able to participate in the government securities market. Another example could be in terms of how SEBI has been trying to reduce the face value of bonds. So previously, if you wanted to buy a bond, your minimum investment size would be 10 lakhs, because that would be the face value, right? And now you have bonds that are coming out at 10,000 rupee face value as well as 1 lakh. So that minimum face value was brought down to 1 lakh and then again to 10,000 rupees. This makes sure that more people have access to investing in bonds. So, and obviously then the trading also improves. The third risk is re-rating. So let's say you invest in a company at a particular point in time, and over time their financial situation actually deteriorates. Then they might get a lower rating in the future. But re-rating happens only when somebody goes to the market to borrow. So many times what tends to happen is the financial situation of the company could be deteriorating, but just because they're not coming to the market to borrow, you might not actually see a re-rating occur. So it's very important to know who you are lending money to, how their finances are, and to keep a close eye on those financial metrics. The fourth risk that we're going to look at is inflation risk. And inflation risk essentially means that what I was talking about, right? If you had made a fixed deposit investment during the pandemic in 2020 or 2021, maybe the interest rate that you would have got on that particular FD would have been 4 or 5%. So similarly, there are times in the bond market where your credit spreads actually compress, which means you're not getting too much reward for the level of risk that you're taking. And if you invest in government securities, or if you invest in very safe investments that are giving you guaranteed assured returns, you might not actually beat inflation over a period of time. Right. So 4% FD is not going to beat inflation today. And it certainly didn't beat inflation 1 or 2 years ago either. So this is where your inflation risk lies. And the last risk is interest rate risk. And we'll spend a little bit more time on this with some illustrations so that you can actually visualize how this works. So we need to look at something in terms of the bond price versus the yield, right? So when we're talking about interest rate risk, if you've attended any of our webinars or Twitter spaces, every time the RBI has a meeting, we do an update on what's happened in the markets and whether interest rates have changed. So the idea is that the RBI kind of sets the level of interest rates in the economy, right? And this level trickles down into the rate at which banks borrow, the rate at which other corporates will borrow, and so on. So when interest rates move up, the cost of money actually increases, right? So then the tendency to borrow will come down. So if, let's say, you have an NBFC which is borrowing at 9%, right? And the interest rate moves up by 0.5%. Now, today, any bond that gets issued by that same NBFC will have a fresh bond will have to be at a higher interest rate than 9%, right? So the demand for the new bond will go up and the demand for the old bond will come down. So when demand comes down, the price will actually reduce, right? So what you're seeing here is that when the interest rate moves up, the price of the bond actually comes down because the yield also has to go up. Because if it's the same issuer with the same maturity timeline, both the bonds cannot be trading at different returns for the investor, right? Then obviously the investor is going to choose the one that's giving them the better return, and then automatically your price will readjust. So it's a very interesting mechanic between where the interest rate is or your cost of capital, where yields are, and where the bond price is. So bond prices and yields actually move in the opposite directions. So now we'll move on to how you can invest in bonds. So the first and obvious option is that you do it directly, for which you need a demat account. And because this is a dealer-driven market, you would ideally need to go through a broker or a distributor, somebody who can help you select or identify the bonds that you want to invest in, right? And keeping in mind that bonds, unlike stocks, so if you have a particular company, they're probably going to only have 1 or 2 types of shares, right? So you might have a special kind of share where you might have differential voting rights, or the ability to earn more dividends, and you might have the regular share that gets traded on the exchange, but that's about it. But the same company, if it was issuing bonds, each year they could borrow money from the market, which means you'd have a different bond every time. So even for the same company, there might be multiple bond offerings that are available for an investor, right? So security selection is very important. And I think Vinayak talked about covenants as well as other elements or features of a bond. And you need to pay attention to all of those features and elements when you're choosing a product. The second method is that you invest in mutual funds, because fixed income mutual funds own bonds. Now, the advantage of a mutual fund over directly purchasing the bond is, of course, that you have more control over the liquidity. Can we go back to the slide, please? Yeah. That you have more control over the liquidity in terms of your entry and exit can be much smoother because the liquidity risk is managed by the mutual fund house. The third alternate is something that has actually a space that has grown quite a bit in the last few years, which is the alternate investment fund space or AIFs. This primarily caters to high net worth individuals who are willing to put in a sum of 1 crore in fixed income markets. And there are many structures here. So one of the types of credit that Vinay talked about was venture debt. So you have private credit, which is essentially not goes beyond just your typical banks, non-banking financial companies, PSUs, municipal corporations, or government securities. So you might have companies that are not even in the financial space that are looking to borrow money, and that could show up in your AIF portfolio. So quickly touching upon what a debt mutual fund is. So debt funds invest in bonds and deposits, and they are categorized in a very neat manner. So investors can know exactly what kind of horizon or risk they want to take within a debt mutual fund. Because the portfolio has to be marked to market, that means daily the prices of these bonds are updated, and because the price gets updated, you have something known as the net asset value of the fund, which may go up or go down, right? So the NAV may go up when there is higher demand, or if a particular company goes through a rating upgrade, then automatically the price of that bond goes up. Or if there is interest payment from the company where essentially there's more cash in the portfolio, so automatically your NAV will go up. Some examples of what may cause the NAV to go down are if there's any default or delay in the payment of interest, or if a company goes through a rating downgrade, or if there's some negative coverage about the company's financial strength, then your NAV may go down. You can also have these one-off events where, let's say, a lot of investors are worried about the quality of the fund and many of them decide to take their money out at the same time. Then that redemption pressure might force the fund manager to sell bonds at whatever price is available. And because the bonds are getting sold in distress, you might not earn the kind of fair value that you should have. So that will again cause the NAV to go down. So the most important thing to note here is that debt funds are actually different from fixed deposits in the sense that in your FD, you're going to continuously get a fixed rate of interest over a period of time. And then there's a maturity timeline at which the FD will mature, and then you can decide how you want to reinvest those funds. In a debt mutual fund, whatever interest payment comes, it accrues into the fund, so that allows for steady compounding. And there is no fixed return because you have two sources of return, right? One is the coupon payment, and the second is, of course, your mark-to-market movement. So you can't actually look at a debt fund and say that, in 3 months, the fund value should be so much, because there are two sources of returns and one of them is quite unpredictable. And the second source also may not be so predictable because the underlying portfolio of a debt fund can also change. That is, a fund manager may buy or sell a bond, which would change the return profile of that fund. So a quick look at how debt funds are categorized. You have income funds, you have gilt funds, you have liquid, you have ultra short, and you have fixed maturity plans. So there are a lot of different categories, but SEBI has been quite investor friendly in the recategorization. So one way of segmenting debt mutual funds is based on their maturity. So if you're looking at a short-term fund, that would very clearly have a duration between 1 to 3 years. If you were looking at a medium-term fund, that might mean 3 to 4 years. And if you were looking at a long-term fund, the duration might be between 7 plus years, right? And then if you were looking at liquid funds, they ideally invest in 1 to 3 month securities. right? Ultra short would look at 3 to 6 months. Money market would be under 1 year. So maturity and duration is one way to categorize a debt portfolio. Then you might have based on what is in the portfolio, right? So if you have a corporate bond fund, that would typically mean high rated, that is ideally AAA or AA plus and above securities would constitute 80% of the portfolio. You might have a banking and PSU debt fund, which invests only in bonds that are issued by PSUs or banks. You could also have a gilt fund, which would essentially mean that they're investing only in government securities. So this is a mandate-based portfolio, right? And then you can, of course, have a category like a dynamic bond fund that allows you to be very flexible and move with the market in terms of what the portfolio construction, whether it's in terms of credit, the credit quality, or in terms of the duration of the fund. There's a lot of flexibility for the fund manager to move in that particular category. Then you have something known as fixed maturity plans, which are ideally only for a fixed amount of time. This used to be very popular when there was indexation, but now you don't really see so much or so many issues coming out on the FMP side. All right. So there are 3 categories for the AIF space. So you have category 1, which is essentially venture capital or infrastructure. And this tends to be in unlisted securities. Then you have category 2 AIFs, which are private equity or debt funds. And then you have category 3 AIFs, which basically allow you to use leverage and complex trading strategies, right? So typically, most debt AIFs are within the category 2 bucket, but you can have debt funds in either category 1 or category 3, depending on the solution provider. So let's take a quick look at how these instruments are taxed. So if you have a listed bond, then up to 1 year, if you buy and sell, that's considered a short-term trade, and the tax liability for the gains that you make out of that trade is 20%, right? If it is more than 1 year, sorry, this should not say slab rate, it should say 12.5% for a listed bond. Any interest that you earn, by the way, is taxed at your income slab rate, whatever that rate is. Unlisted bonds are taxed, both your long-term and short-term capital gains are taxed at your slab rate. For mutual funds, also the debt mutual funds at least will be taxed at your income slab rate. So with your category 2 and category 3 AIFs, depending on whether the taxation is passed through or not, or the structure is passed through or not, you might be taxed at the fund level or at your slab level. This is an important question that you should ask before making an investment into AIFs. So now let's look at what instruments are actually suitable for an investor. So if you want a listed bond, you can have low to moderate risk. The liquidity may not be as high as you would expect, but it is efficient if you're looking at trades. But again, you need to evaluate how feasible a trade is. If you're looking at unlisted bonds, the risk is higher because your entry and exit is comparatively tougher. The liquidity is much lower compared to a listed bond, and the taxation is at your slab rate. In your mutual fund category, your risks are much lower because you're typically in a very narrow universe, and ideally most mutual funds do not cross below AA in terms of ratings as the instruments that they're investing in, because they need liquidity, right? The liquidity is very high, and the tax efficiency is that it's taxed at your slab rate. So with your category 2 AIFs, this is a much higher, both category 2 and category 3 are much higher risk products. And they do have moderate liquidity. So again, this is based on the fund structure, right? So if the fund has a liquidity provision, then you will have more liquidity. If it does not, then you're sort of locked in till maturity as per the fund structure. So fixed income works in cycles pretty much like equities or any other asset class, but most of us don't really see these cycles because we are only looking at the interest rates. So if we look at how we've categorized these sort of themes in fixed income, right? So we can look at short-term treasuries, which are your T-bills. We can look at long-term treasuries or long-term government securities, which is your GSEC. And then we can look at credit, which is like your higher or rather your lower rated bonds, which are issued by corporate entities. And then you can look at higher rated bonds that are issued by corporate entities. So if you see this, you can have years where fixed income, some particular category, subcategory of fixed income actually does well. So if you look at 2010, 2011, corporate bonds were actually doing really well. Interest rates were lower, which meant that credit was not the best decision to make at that point in time. And then you can look at after interest rates move up, then you can look at government securities. So whenever you see government securities come at the top of the table with double-digit kind of returns, that essentially means that your interest rates have gone from being at a very high level to a very low level. So if we move towards 2020, you'll see that 2018, 2019, 2020, government securities did really well. And then in 2020, you had a series of rate cuts. So 2021 returns were actually not that attractive, and 2022 returns again were not very attractive. Then when your interest rate hikes started happening again, your government securities started performing. So this is basically how cycles work. They're primarily influenced by macros as well as interest rates. So today's opportunity in terms of where you can participate or why you should consider fixed income in your allocation is that equity markets are at an all-time high, which means you need to question how sustainable it is for you to invest in that market in terms of forward returns. So can you set the same kind of expectations as what you've had in the past? Will past returns actually reflect what your future returns are going to be like? The second important factor is that interest rates are at an all-time high, which means that if you want to lock into a good return, this is a great time to do that. The third thing is that your credit spreads are actually widening. So you might get better opportunities to participate in certain structures where you'll earn better returns as these spreads widen. So the important thing is not to participate fully if you're looking at the credit space, right? And then you have the big news item, which is that India sovereign bonds have been included in global bond indices. And when that has happened, that has created a flow or a demand for Indian government securities, which is why even though your interest rates have moved up, you're not really seeing the spreads on that space really widen, right? And given how global dynamics are at this point, as well as how India is structured from a macro perspective, this is like a long-term structural change. And lastly, of course, we have our fiscal deficit consolidation. So if we look at what's been happening in the last few budgets, we would have noticed that the government has been trying to bring down the fiscal deficit in a sustainable and sustained manner. And that is very positive for bond markets because it essentially means that there will be lower supply of government securities in the market. And when supply is less, the prices will go up, which means investors can make mark-to-market returns. So with that, we'll close for the day. And we'll be happy to take in questions. I think there are already a few in the chat box. So I'll start answering those first. And then please feel free to type in anything that you have, whether you're watching us from YouTube or if you're directly here. Yes, this will be on YouTube, and we're also live on YouTube now, so you'll be able to access it in case you've missed anything, or if you want to leave now and come back and look at the Q&As later. Is the safety rating of a bond remains the same during the bond period, or it can vary depending on the issuer's position? So like I mentioned, when it comes to ratings, you do the rating agency will only rate a bond when it comes in for issue, right? So there is no proactive review of the company's status that happens by the rating agency. And ideally, it is the corporate that pays the rating agency for evaluating its finances and issuing a particular rating. So if the company's health deteriorates, but they don't come to the market to borrow, then the rating agency isn't going to proactively sort of warn and say that this is, there's a potential downgrade or the outlook for that particular company has changed. This is why it's important as an investor to actually pay attention to the balance sheet quality and health of any company that you're going to lend to. Okay. So can you repeat what are covenants? What is meant by interest rates, bond prices decrease? What is the difference on bank FD of 7% and state government bond of 7%, which is safer? Okay, so covenant is basically a term, you can think of it that way. So when a bond is issued, there's something known as an indenture, which is like a legal agreement that the issuer makes, which binds the issuer and the lender, right? The borrower and the lender. So there will be certain terms on that agreement. So for example, one term can be that if I default, let's say I'm the borrower and you are the lender, I can say that if I default or I delay any payment in interest, then the next coupon onwards, I'll pay you 0.25% more. So that's known as a step-up covenant, right? Then I may also say things like this bond cannot be called. That is, I won't be able to say that, hey, tomorrow I'll pay your principal back. Or I might say I can call it back, but I will call it back on specific dates. Or I might say that, if I don't maintain this particular credit rating, then you have the right to sell the bond to me at your face value. So these are all different types of covenants. Even things like whether the bond is secured or not secured are important elements, right? Rating is something that a credit rating agency does for a particular bond issue. So the same company, for example, can have two different credit ratings, because let's say I have one bond which is secured and I have one bond which is unsecured. The secured bond may have a higher credit rating than the unsecured bond, even though it's the same company that's making both of those bonds, right? So the difference between a bank FD at 7% and a state government bond at 7% is that bonds get traded on the market, whereas FDs don't, right? So your principal is always the same. You don't get any variation in return. You will still earn that 7% coupon in both the instruments, but the price of your state government bond can change. So that bond can trade at a loss or at a surplus. Now, when you do an FD of 7% and it's a compounded FD where you get cumulative returns at the end, then that FD is getting reinvested at 7% guarantee. When you have a state government bond or any bond that is giving you a 7% return, the interest comes to you and you have to reinvest that interest. And that means that you cannot take it for granted that you will be able to always reinvest it at 7%. So in terms of safety, it is up to you to decide. But ideally, like your FD gives you a way more guaranteed structure of return than a bond does. But at the same time, the FD cannot actually give you any mark to market or surplus returns, right? So it's up to the investor to decide what it is that they want. And typically, because FDs give you better returns, your rates on the FDs are going to be lower than the rates that you get on a bond. If you have any specific questions about your portfolio, we can discuss it offline. Vinay, do we have our contacts there? Maybe you can show that. Yeah, you can reach us at 9677000613. You can drop us a message on WhatsApp, or if you want to write us an email also, you can do this. And our team will get in touch with you to discuss your portfolio and maybe what is suitable. Ideally, on this platform, we don't give generic advice because it may not suit people, and there are a lot of people here, and we won't want to be wrong in what we're saying. And we have a certain process that we follow in evaluating your requirements as well as your asset allocation needs, your risk profile, before we can actually work with you on product selection. Okay, I'm not clear on the difference between debt mutual funds and bonds. Could you explain with a little bit more clarity? So a bond is a single instrument, right? You can create a portfolio of bonds with multiple bonds, but when you invest in a mutual fund, the portfolio is already created. So you are buying a basket of bonds directly from the asset management company. Now, when you want to sell your bonds, you have to go back to the broker dealer and say that I want to sell it or I want to buy another bond. When you invest in a mutual fund, you can, let's say you have an SIP running in a debt mutual fund. Every month, 10,000 rupees is going into that particular fund. The fund manager will decide where to put that 10,000 rupees. You don't have really a choice in where that goes, right? Similarly, if you are a retired person and you want to take out 10,000 rupees every month, the fund manager will decide where to which bonds to sell so that they can generate that liquidity and fund your monthly withdrawal plan. So this is broadly the difference. You need to think of it in terms of how much say do you get in what you're buying, which is lower in a mutual fund and higher in your own bond portfolio. You need to think about liquidity and impact costs, which is higher in the mutual fund and lower in your own portfolio. And you need to think about in terms of mandates. So debt mutual funds have very clear mandates, right? So if I'm in a corporate bond fund, it is pretty much 80% of the portfolio is going to be in AA plus and above rated assets. If I am in a gilt fund, it is only going to be government securities. Whereas your bond portfolio, depending on what you want to buy, can contain anything. NCD stands for non-convertible debentures, and debentures are also bonds. So yes, an NCD is the bond. How are the listed bonds pricing linked to interest rate movements? If you can explain once again, please. So ideally, what I was saying was you just need to, the relationship that you need to keep in mind is that listed bonds, when the interest rate moves up, the yield of the bond moves up. And because the yield moves up, the price has to come down, right? Because the demand for the bond at a low, like if we have a 9% bond and the interest rate moves to 9.5%, then most investors would prefer to participate in the 9.5% bond, right? So the demand for the 9% bond will come down. And when that comes down, the price of that bond will also come down. But when the price comes down, the yield will improve, right? Because on, let's say 100 rupees, if I'm earning 9 rupees, on 99 rupees, if I'm earning 9 rupees, then my yield becomes 9 by 99, which is 1 by 11, right? So the yield will basically increase. It will try to adjust such that the new bonds and the old bonds are trading at the same return range for the investor. Yes, we can help you if you're interested in purchasing bonds or if you want to participate in the mutual fund services as well. I think Milestones to Wealth, our main aim is to take 1 lakh investors from wherever they are to their first crore in savings in financial instruments. So whether that's through mutual funds, FDs, bonds, our team can definitely assist you with those investments. I've also left our contact details here so that you can reach out and we'll be happy to get in touch with you. There are many categories. So you have dynamic bond funds in mutual funds, you have corporate bond funds, you have banking and PSU, you have government securities fund, you have fixed maturity plans, you have liquid funds, short term, medium term, long term, all of these categories. So based on credit also is one category of mutual funds. So we don't think that either one is better. It actually depends on what you require, right? So if you require liquidity, then 100% debt mutual funds are better than bonds. If you're interested in a regular income stream, then bonds can actually give you a decent source of higher returns in terms of interest payment, right? On the debt fund side, you can do an SWP where you get a guaranteed assured withdrawal every month, but it may not come at the same rate of return as a bond. But again, it depends on what kind of bonds you're choosing, right? If you're choosing government securities or PSUs, maybe the returns will be very comparable. What you're getting in the mutual fund versus what you're getting from those securities will be quite similar. Yield to maturity is the same as yield. It basically is a time value of money metric, which takes into account all the cash flows that an investor is earning through the life of the bond and throws out something like a return expectation. But like I mentioned, there are some drawbacks with the yield to maturity, and we need to keep in mind that those are very important assumptions, and you cannot take it for granted that the YTM is the return that you will earn. Sometimes based on the YTM, you might earn a higher return or even a lower return. So again, the minimum money required to invest in the bond depends on the bond itself. So it's basically a function of the face value. Like I mentioned, if you have, like SEBI has been trying to reduce the face value so that the minimum investment is lower and more investors can actually participate at these levels. I think I've answered this. Multiple bonds provided during different times by the same company will not necessarily carry the same rating, right? If my financial strength improves, then automatically my rating will also improve when I come to borrow the second time. Similarly, if my financial conditions deteriorate and I'm coming into the market and I get a fresh rating, my rating may not be the same. Moreover, you see that, let's say you have a small microfinance company. As that company grows and gains market share, the strength of the balance sheet, etc., will improve. So sometimes a company that you trusted a lot in the beginning, as it's growing and becomes a more mature company, might be borrowing at a much higher rating. So you won't get the same kind of return also from that same issuer. Mark to market is just deciding what is the price of the bond in the market today. So if I have a bond that I price at 100 rupees, and then during the day it trades at 100.2 rupees, then that 0.2% is the 0.2 rupees is the mark to market, right? That's a gain. So it can be negative also. If the bond trades at 99.8 rupees, then I'll be 0.2 rupees lower or 0.2% lower. Yes, bonds can be pre-closed by the issuer. This is known as a call option. So they can say that after 5 years or after 10 years, they will call the bond, right? Or they have the option to call the bond. In which case, if the issuer decides that they want to call it back, this can be, let's say, today I'm borrowing at 10% and I take a 10-year bond. And I expect that over the next 5 years, my financials will improve and my cost of borrowing may come down from 10 to 9%. Right? As an issuer, I can put a call option at 5 years and then I can exhaust this. That is, I can buy back all the bonds and borrow money again at 9%. Right? So then my total interest cost will reduce from 10 to 9 on my borrowings. So this will affect the returns of the investor, because if you had expected that you would earn a 10% return for 10 years, then you're only earning 10% for 5 years. And then if you want, you'll have to earn 9% for the next 5 years. So that's something that you can think about. What is inversion curve and how will it affect us? So we wanted to keep the presentation quite simple today, but ideally what an inversion curve is that you have something known as the yield curve, right? Which is, if I start plotting every bond, like every government security in the market based on the maturity versus the yield, ideally you would want to have an upward sloping yield curve, meaning obviously it's more risky to lend to somebody for 30 years than it is to lend to them for 1 month, right? There are so many things that can happen in 30 years which can't necessarily happen in 1 month. So that's the normal shape of the yield curve, right? But an inverted yield curve means that people are more worried about the near term than they are about the long term. So, for example, if we look at how the US markets have been for the last few years, people have been talking so much about a recession that they were worried about how the US would be in the short run. They were not so worried about the US's long-term prospects, because in the long run, they knew that, okay, this is just a few-year problem. After that, it will settle down and it will get back to normal, right? So in that case, you can have an inverted yield curve, which is like the way to think about it is it's not a normal shape, and you're more worried about the short-term prospects than you are about the long-term prospects. If you are interested in AIF, we can sit down with you and look at how that would work. That's not a problem. Is there any limit like PMS for us to get? No, there is no limit. It basically depends on the issuer. So if you are in touch with anyone from our team, you can tell them that you're interested in bonds and you can tell them how much you have to invest, and we can try to find bonds with within that investment range. We have done some other presentations on risks and history of bond markets. Maybe you can look at our YouTube channel and look at what has happened, because I think it can take quite a bit of time if we get into that. If a bond is issued at 9.5% coupon rate and due to price increase, coupon rate decreases to 9%. In that case, first time I would be getting interest at 9.5%, second time. So the corporate who have issued bond need to spend interest on out their income according to the rates. I'm not sure I understand this question, but your bond coupon cannot change, right? The yield can change, your cost of borrowing can change. So if I issue bond A at 9.5%, I can issue bond B at 9% if my financial strength improves, right? So then in the two bonds, you'll earn 9.5% on the first bond and 9% on the second bond. And whatever interest you're earning, yes, the corporate has to spend out of their income. So if you are reading the P&L, etc., you'll have an interest cost. There is no best fund as such, right? We specifically, like the way that we operate in fixed income is like we like to manage the risk very well, which means that we're not actually looking at the best return funds. For us, fixed income is a space for safety. If you are only looking at the best return, then you can look at, then there's no need to evaluate anything, right? You can just look at wherever the highest yield is coming for you and participate in that if you're looking at funds. But again, you need to be aware of the risks, because in debt mutual funds, you are exposed to both interest rate and credit risk. A little bit about credit risk funds. Ideally, they don't have, so they have to invest in AA minus securities largely, or below, like AA and below. So it's not a pure AAA portfolio. Typically, because you want liquidity, you will have, you would prefer to have lower maturity bonds, because that's what will give you the ability to enter and exit easily. And they tend to be more actively managed, so they have like higher expense ratio. So I think that's more or less like the highlights of a credit risk fund. Okay, last time one request was to give an overview of your cost structure of your PMS products, including all charges. So like we have done this webinar for milestones to wealth, which is why we don't have our PMS deck here. But like I mentioned, if you drop us a message or if you just leave your email with us, then we can give you an overview of all the PMS products, and we can also set up a one-on-one call to discuss this. I'll ask our team to get in touch with you, sir. If you dropped us a message, 100% someone will get back. We're quite active. If we've missed out on getting in touch with you, we will resolve it immediately today. Yeah, you do have bond index. You have more of these like target maturity funds. They all follow an index structure. Bonds issued by the RBI are issued on behalf of the government. There's not too much that they're higher, they're more secured, they're safer investments. That's about it. So I think we're at the end of our presentation and the questions. Can gold bonds be traded? Yes, they can. So I'm going to make this the last question because we're already overshot our time. Okay. Gold bonds can be traded, but it's not a very deep market because only retail investors participate, and typically they are hold to maturity investors. But if you want to exit, you can. Entry will be difficult. If I am not wrong, recently issued size of bank bonds have been increased to 1 crore. What is the rationale? So typically bank bonds are retail, are not really retail investments, especially if they are like tier 1, tier 2 capital requirements, right? So the perpetual bonds, there have been instances of non-payment, whether it's with Yes Bank or LBB. So I think the idea was to have a regulatory framework that minimizes retail participation in those kind of investments and allows only institutions to take that kind of risk. It is a complex market, but again, see, I don't see any problem in a retail investor deciding where to invest. It's more about how much risk you want to take. Any product where you're going to take more and more risk, you are going to need to put in more and more effort to understand that. Mutual funds are a great way for anybody to participate in the bond market. It removes the entire liquidity risk from the investor. There's also no need to have a demat account. There are different ways to participate, which may not be feasible for a bond investor, right? If you have 10,000 rupees to save every month, you can't be buying a bond every month, but you can participate in mutual funds through that process. So it's really up to the investor. Our goal today was to just give an education and an overview. If you'd like to work with us, we welcome you to work with us. We are committed to working with a lot of investors. But if you want to pursue it on your own, then I think there's enough information here that you can take and work on. Thank you. Thank you, sir. Of course, we'll be here every week, multiple times each weekend. Do join our M2W webinars. I think our latest initiative is that we want to do it in Tamil every week. So there'll be something or the other that's happening from our side. And of course, on the PMS side also, there will be product-based webinars for whoever is interested in that. Sure. I think if you are part of our broadcast list, you will also receive the direct link. All right. All right. Thank you, everyone.
Thank you all for joining this webinar, and thank you Sam too for this detailed presentation, and wish you all a happy Ganesh Chaturthi.